Meta just delivered a powerful Q1 2026 earnings report with strong revenue growth and solid profitability, yet the stock has recently pulled back, raising questions among investors. Hello everyone, welcome back. In this video, we will break down Meta's latest earnings report and understand what is really driving the stock movement. Looking at the headline numbers, Meta delivered impressive results, with revenue jumping 33% year-over-year to approximately $56 billion. Operating income also increased by nearly 30%, reflecting strong efficiency in Meta's core advertising business. This demonstrates Meta's ability to scale profitably while optimizing costs, underscoring their financial resilience. Meta's earnings show strong results, with revenue up. However, despite these strong results, the stock reaction has been mixed, mainly because expenses are rising faster than revenue growth. This divergence between rising costs and revenue growth is one of the key concerns currently weighing on investor sentiment. Another important factor is the significant boost to net income driven by a one-time $5 billion tax credit. This one-time event is a key reason for the stock's recent pullback as investors look past the temporary boost. This one-time benefit pushed net income growth to over 60% year-over-year, making the results appear stronger than they actually are. Without this tax credit, Meta's earnings growth would still be solid, but noticeably less dramatic. Let's look at the adjusted versus reported earnings. The difference highlights the true operational performance. This is why investors are focusing more on the quality and sustainability of earnings rather than just the headline numbers. Let's look at the split between headline and core earnings. Looking ahead, Meta is guiding for another strong quarter, with expected revenue growth of around 25%. This suggests that the company's core advertising engine is still performing at a very high level. But despite this strong outlook, the market is focusing more on what could slow things down going forward. Concerns like market saturation and rising costs could impact future growth. And the biggest concern right now is Meta's aggressive increase in capital expenditures. As you can see on the screen, their capex is rising sharply. This could significantly impact their profitability. The company has raised its capital expenditure guidance by nearly $10 billion, signaling massive investment ahead. This underscores their commitment to scaling infrastructure. This surge in spending is largely driven by Meta's aggressive push into artificial intelligence and large-scale infrastructure build-out. These massive capital expenditures are strategic investments to secure Meta's future in the AI race. The company is investing heavily in AI models, computing power, and hardware to stay competitive in the next wave of technology. This strategic focus positions them for leadership in the AI revolution. While these investments could drive long-term growth, they are significantly increasing short-term expenses. This creates a classic trade-off for investors to consider. This creates a classic dilemma for investors: strong future potential, but rising near-term pressure on profitability. The chart shows the conflict: future growth versus present costs. It's about weighing that risk. And this uncertainty around returns on these investments is one of the main reasons behind the recent stock pullback. Despite rising costs, Meta's core advertising business remains extremely strong and continues to drive the majority of its revenue. This strength is clear in the ad revenue dashboard. Both ad impressions and the average price per ad are increasing at the same time, which is a powerful and rare combination. This dual growth is driving Meta stock higher, signaling strong momentum in their ad business. This trend clearly signals strong advertiser demand across Meta's platforms, reinforcing its competitive positioning in digital advertising. In fact, this strength has sparked discussions about Meta potentially challenging Google's dominance in the advertising space. If this momentum continues, Meta could capture a larger share of the global digital advertising market over time. On the user side, Meta continues to operate at massive scale, with billions of users across its family of apps worldwide. However, there was a slight dip in daily active users this quarter, which caught the attention of analysts. This decline was largely driven by external factors, including internet restrictions in regions like Russia and Iran. These restrictions are impacting Meta's international operations and user base. Importantly, this does not appear to reflect a fundamental weakness in Meta's core user engagement. Daily active users remain stable, and revenue per user is up 16%. This pullback is a short-term reaction. Instead, it highlights how external geopolitical and regulatory factors can temporarily impact user metrics. These risks can cause short-term dips in user engagement, as we're seeing here. Meta's long-term strategy continues to be driven by Mark Zuckerberg's vision of building the next generation of intelligent digital systems. He describes this direction as a move toward personal superintelligence, designed to assist billions of users in their daily lives. These systems are expected to evolve into intelligent agents capable of enhancing productivity, communication, and decision-making. To support this vision, Meta is aggressively investing in infrastructure, talent, and advanced machine learning models. These investments in data centers, AI chips, and engineering teams are crucial for long-term growth and maintaining a competitive edge. This makes Meta not just a social media company anymore, but a long-term AI infrastructure and platform player. Despite rising capital expenditures, Meta continues to generate exceptionally strong operating cash flow. This cash flow strength gives Meta significant flexibility to fund its massive AI investments without destabilizing its core business. It also allows the company to continue investing aggressively while maintaining balance sheet stability. This strong balance sheet gives Meta the flexibility to navigate market challenges. This combination of high cash generation and strategic spending is rare among large-cap technology companies. Meta's cash flow far exceeds its peers, like Apple and Microsoft, while it invests strategically. And it reinforces Meta's position as one of the most financially powerful companies in the global tech sector. From a valuation perspective, Meta is currently trading in a zone that many analysts describe as controversial. The chart shows Meta pulling back after earnings, landing in this highlighted valuation band. This range from low to high frames the current market sentiment. Some investors believe the stock remains undervalued relative to its long-term earnings potential. As you can see on the screen, this pullback after earnings creates a compelling entry point. The bull case is strong here. They point to strong cash flows, dominant advertising position, and long-term AI growth opportunities. These strengths combine to create a powerful growth engine for Meta, supporting a bullish case. On the other hand, some argue that the stock already reflects too much of this future growth. This divide in investor sentiment is what makes Meta one of the most closely watched stocks in the market today. Despite strong fundamentals, Meta is not free from risk, especially as it scales its aggressive AI investments. Let's add this risk layer to the chart. One of the biggest uncertainties is whether these massive AI investments will generate returns at the expected scale. As you can see, the returns line starts to dip here, highlighting the ROI uncertainty. If returns fall short, pressure on margins could increase significantly in the coming years. The chart shows Meta's profit margins compressing after earnings. This is a key risk investors must monitor. This creates a delicate balance between long-term innovation and short-term profitability. Meta's pullback highlights this strategic trade-off. It's a key consideration for investors. And that balance is exactly what investors are trying to evaluate as Meta enters its next growth phase. To understand Meta's earnings story, we must separate short-term market reactions from long-term business fundamentals. This split view highlights the short-term pullback versus the consistent long-term growth. While the stock reacted negatively in the short term, the underlying business remains fundamentally strong. Meta's earnings beat estimates with strong revenue growth. This positions them for long-term success. Meta continues to dominate digital advertising while simultaneously building the foundation for its AI-driven future. This combination of cash generation and aggressive reinvestment makes the company unique among its peers. As you can see from this comparison with other top tech companies, Meta's metrics truly stand out. However, investors must carefully evaluate whether future AI investments will translate into proportional returns. This balance between growth and execution risk will define Meta's next phase of performance. The stock chart shows the pullback post-earnings. This balance is the key strategic insight. In the short term, volatility may continue as the market adjusts expectations. As you can see here, the chart shows volatility spikes, which are now smoothing over time. This is a short-term warning to proceed with caution. But in the long term, earnings growth and cash flow will remain the primary drivers of value. As you can see on the screen, these metrics show a consistent upward trend over the past few years. This is why many investors view Meta not as a short-term trade, but as a long-term structural growth story. If you found this analysis valuable, make sure to like, share, and subscribe for more deep dive market breakdowns. I'll see you in the next video.